The Great Depression hit the world economy like a storm in 1929. Unemployment and poverty skyrocketed. American GDP shrank by 30%. Meanwhile, in Canada, this figure was closer to 40. Throughout the decade-long depression, 9,000 banks went bankrupt in the US. Meanwhile, in Canada, only one bank closed, Weyburn Security Bank, a small bank in the sparsely populated prairies. And in fact, this single bank was owned by an American. In the last 2 centuries, the American financial system failed 9 times. And I'm not talking about the recessions and the market downturns. These were instances where the financial system itself either collapsed or was so close to collapsing that the government had to bail it out. Wall Street is one of the few places where companies can fail every 2 decades and still be in business. But perhaps the greater win for the Wall Street is their ability to make the entire world believe one of the greatest myths of all time, the inevitability of boom and bust. As the story goes, the booms and the busts are the results of unforeseen and extraordinary circumstances, like earthquakes and hailstorms, a force of nature. We believe this because it is the version of events told time and time again. Well-intentioned and highly skilled people do the best they can to create effective financial institutions, allocate credit efficiently, and manage problems as they arise. But they're not omnipotent. Unable to foresee every possible contingency, the bankers sometimes are subjected to strings of bad luck. Economic shocks, which could not possibly have been anticipated, destabilize an otherwise smoothly running system. Banking crises are like Tolstoy's unhappy families, all unhappy in their own ways. But this is an illusion. It's make-believe. There is a reason why Wall Street fails almost as often as Argentina. Meanwhile, the Canadian financial system, or many other financial systems across the world, have never failed. And the reason is simple. The Wall Street is designed to fail. The United States is the only developed country that has frequent, regular banking crises. And the worst part of it is when America sneezes, the world economy catches cold. Every few decades, the entire world gets hit by a recession originating from Wall Street. And this isn't natural. This isn't a law of economics. This isn't supply and demand. It isn't the greedy bankers of Wall Street neither. It isn't about individuals. The problem is systemic. This is why most of the financial crises happen in select few countries, and a lot of countries never have domestic crashes. Bankers in Canada are no less greedier than the bankers in the United States, yet the Wall Street keeps failing. Meanwhile, the Canadian financial system does not. So, why does this happen? Part of the American problem has been fragmentation, both in regulators and the banks. Branch and federal banking was a major political hot topic in early American history. Alexander Hamilton was a major supporter of a federal banking system, the first bank of the United States, that would play a stabilizing role and provide broad access to credit. Meanwhile, Thomas Jefferson was an agrarian populist and was very much against the Bank of the United States on grounds that it would empower the urban financial elite. Long story short, Jeffersonian thought prevailed in the short term. Interstate banks were banned, and even branching within states was heavily limited. The result was roughly 20,000 single-branch banks dominating the American financial sector, all the way to 1980s. It was only with Reagan-Neal Interstate Banking Efficiency Act of 1994 that nationwide multi-branch banks were fully legalized. Now, the too-big-to-fail mega banks that emerged as the result of this act came with their own problems. But the incredibly fractured single-branch banking system that came before was the main cause of many financial crises. The problem with the system back then was the possibility of a financial cascade. Information cascades occur when a local financial crisis, for example the failure of a bank, causes the failure of other financial institutions as people start panicking and pulling their assets out of the financial system. This leaves otherwise secure banks unable to cover their short-term obligations, eventually engulfing the entire economy. And financial crises resulting from information cascades happened all the time with these single-unit banks. These banks were entirely dependent on fluctuations of local economy or the narrow sector that they were invested in. A simple downturn in agricultural product prices in a single year could collapse hundreds of banks that entirely depended on the profits of a single crop type. But as we all know, this is history. We can't blame all the economic and financial crises on the fractured banking system of pre-90s America. But in 2008, just like today, the banking system in America was a different breed completely. Nowadays, the American banking system is dominated by global megabanks that are too big to fail. Ironically, it's a system that neither Thomas Jefferson or Alexander Hamilton would like. It is larger, more centralized, and powerful, while being less responsive to the needs of the average citizen than Jefferson would have wanted, and far less stable than Hamilton envisioned. Although Hamilton would have been pleased with the system's ability to raise capital for new ventures from globally, he would probably be shocked at its fragility, which requires massive government and central bank assistance. But even in the age of megabanks, the American financial system remains fragmented. Four almost distinct pillars dominate the American financial system, and then this is further fractured by the shadow banking systems. These are commercial banks like your Bank of America, investment banks, insurance companies, and S&Ls. Up until 1999, Glass-Steagall Act separated commercial banks from investment banks. The act was repealed with the Gramm-Leach-Bliley Act of 1999, but its effects still shape the financial system today. This is why the US has a massively influential investment banking sector that solely focuses on that. Now, that may sound great to you. Wall Street is free to gamble as they wish with their investment banks, meanwhile consumer deposits are kept safe. But that isn't how the financial markets work. Once one portion of the system fails, the financial cascade will ensure that the entire system suffers for it. All this did was to provide a false sense of security to the markets, while making investment banks more fragile by denying them commercial deposits. This is then complemented by the shadow banking, which is incredibly influential in the American financial system. Shadow banking, as usually defined, comprises a diverse set of institutions and markets that collectively carry out traditional banking functions outside of the traditional system of regulated institutions. Problem with the shadow banking is they tend to love over-leveraging, risk-taking, and they are very hard to regulate effectively. This whole fractured financial system makes it very easy to offload individual risks, but it is terrible at negating systemic risks, which I will exemplify later in the video. In contrast, the Canadian system is entirely dominated by 6 too-big-to-fail banks and a couple of insurance companies, and these banks dominate almost every part of the financial system. This became especially true after the end of the Four Pillars policy in 1992, and all 4 pillars of the Canadian finance, banks, trust companies, insurance companies, and investment dealers were allowed to merge. This resulted in today's Canadian banking system, which is called universal banking and is the most popular system worldwide. In most countries, banks are involved in many different financial activities, which keep them well diversified and usually more risk averse. In Canada, this resulted in a conservative investing culture, where the risk-averse and heavily regulated commercial banking culture dominated capital market operations of these banks. One would think that the repeal of the Glass-Steagall Act would result in a similar environment in the US. However, the result was the opposite. By this point, investment banks were larger or on par with the commercial banks. And when the repeal of Glass-Steagall brought investment and commercial banks together with many mergers, the investment bank culture usually came out on top. The last portion of the puzzle is the regulatory fracture. American banking regulation was never properly established from the very beginning. The discussion around whether the federal government or the states should regulate the banks resulted in the initial victory of the states. American banks initially emerged as state-regulated banks, and federal institutions came into the picture as needed over the centuries. This resulted in a system of patchworks. Even today, there are two banking systems, state-level banks and federal banks. This fracture is then massively complemented by lack of a universal bank regulator. The federal banks are regulated by the Federal Reserve, the FDIC, the SEC, and OCC in different matters. In comparison, almost every aspect of the Canadian banking is regulated by a single organization that is solely focused on this, OSFI. There are two glaring problems with the American way. First of all, the Fed and the SEC aren't bank regulators. That is not their main job. The Fed is the central bank that is responsible for setting monetary policy. The SEC, meanwhile, is an agency primarily concerned with market manipulation. So anything that isn't market manipulation will be out of SEC's main scope. And FDIC is an insurance mechanism. None of these agencies' primary responsibility is to create a stable and robust banking framework, and none of them are capable of something like this on their own, as these agencies only oversee snippets of banking regulations. Between state and federal levels, and many federal agencies that do portions of the regulating, the American regulators are very prone to regulatory competition, and this is something you don't want. Market competition is good. Regulatory competition is a race to the bottom. This allows the banks to pick, choose, and leverage between the regulatory authorities to get the best deal for them. This also makes regulatory capture easier, which is when companies become so influential that they can coerce regulators to do their bidding. Overall, the American regulatory environment is too complicated for its own good. There are too many regulators, too many levels of government at play, and until recently, too many banks to regulate. It also creates an environment where nobody is responsible for the risk that they are profiting from. Meanwhile, in Canada, you have a single bank regulator that only really needs to regulate 6 banks. Overcomplication and over-financialization isn't just a problem for the regulators. It is plaguing the American markets as well. I think the best example of this was the 2008 crisis. Here's how you would think the mortgages work. Someone takes out a mortgage from a bank and pays them back over the mortgage term. But that would be too simple for the American financial system. Here's how it actually works. A private lender gives out a mortgage. If this mortgage is a prime mortgage, then it is sold to a government-sponsored organization, GSE, Ginnie and Fannie Mae, and Freddie Mac. These are called GSEs for short, and their main purpose is to guarantee mortgages or loans given out by lenders. Don't let the government-sponsored part of the name fool you though. For some reason, these are publicly traded for-profit companies, even though their functions are backed directly by the government. Fannie and Freddie then converts these mortgages to mortgage-backed securities, which basically means combining mortgages so they can be traded like stocks and bonds and generate revenue for investors. Fannie and Freddie sell these to a variety of investors such as pension funds, hedge funds, retail investors, etc. For mortgages that don't qualify to be insured by GSEs, they are sold to an investment bank, which converts them to an MBS and offloads it to a special purpose entity, or SPE, a vehicle corporation that is only established to hold these MBSs. The SPE then issues bonds called collateralized debt obligations, called CDOs, which are then sold to investors, insurance companies, hedge funds, other banks, whomever. So by the end, who owns the mortgage issued by the original lender? Who knows? The original loan was packaged and repackaged so many times at this point that it is impossible to tell. In theory, all these hoops and jumps are supposed to make housing financing cheaper and less riskier. This way, homebuyers can afford larger loans and buy houses, though there is almost no correlation between home ownership rates and securitization. No other first world country is as reliant on securitization as the US, yet home ownership rates are largely comparable. Likewise, American home ownership rates did not shoot up after securitization of mortgages became common practice. But maybe more importantly, securitization creates a systemic risk. Here's the problem. In the American mortgage scheme, who is on the hook for issuing bad mortgages? The answer is whomever is left with the bag when, if, the scheme collapses. It's like a game of financial musical chairs, where everyone is trying to offload and spread the risks as much as possible, as soon as possible. But when we look at it systemically, it's just an illusion, as the amount of risk in the system remains unchanged, regardless of how spread it is or who holds it. It doesn't matter how many times the risk is repackaged and changes hand. All it does is that the system shields the lender that is issuing the mortgage from its risks. Now, the lender doesn't care about the riskiness of the mortgage and is free to flood the market with subprime mortgages. But when the system collapses, it brings everyone down. This is why people still debate who was responsible for the 2008 crisis. It was such a needlessly complex and convoluted system that it's basically a chicken and egg game. And at the end, it turned out the risk belonged to the taxpayers, as it was the government that was forced to bail everyone out. Another example of the American financial system being needlessly complicated is the structure of GSEs here. Federal National Mortgage Association, often called Fannie Mae, was split into two companies in 1968, Ginnie Mae and Fannie Mae. The larger Fannie Mae was made a private company. So, at this point, we are talking about a government-supported entity owned by private entities to generate profit. Then the government thought that Fannie Mae needed competition and established Freddie Mac, another private company, to do the exact same thing. Although the government liked to state that it didn't guarantee the solvency of neither, it wasn't fooling anybody. Both of these agencies, for all practical purposes, were fully guaranteed by taxpayer money. Only difference was they made profit for their private owners. So privatized gains, public losses. And that was proven in 2008 when the government bailed out both of them and turned them into publicly traded companies under the conservatorship of the United States federal government. I am not even going to explain what conservatorship is, as that is my point. The entire scheme is needlessly overcomplicated. Why? Why is there a for-profit company established by the government to insure, categorize, and subsidize loans? If the goal is to generate profits, then who's managing the risks and what incentive do they have to manage risks? If the goal is to drive social policies, like increasing home ownership rates, then why is it for profit? And why have two competing organizations that are responsible for checking the risk of these mortgages? How do you prevent standards from being artificially lowered when Fannie and Freddie compete with each other to bring in more mortgages under their portfolio? In contrast, north of the border, here's how things would work in Canada. I'm using Canada as I'm most familiar with the market here, but the rest of the world works very similarly to Canada as well. First of all, securitization rates are very low in Canada. This means that whomever gave out the mortgage keeps it throughout its term and is responsible for the risks. There is no loops and weird hoops. If you issue the mortgage, you make sure it is safe. 75% of the mortgages in Canada are issued and held by the big six banks. And whenever mortgages need to be insured and securitized, you go to the CMHC, Canada Mortgage and Housing Corporation, a single government-owned corporation that is publicly funded. My overall point is that the American financial system is like a TikTok finance guru telling you to arbitrage your car loan to buy partial shares in an Airbnb property under your LLC established in Wyoming, legally owned by your 3-year-old toddler. It is needlessly complicated and extremely over-engineered. And as someone that works in the financial sector, I can't help but wonder, who does this benefit? When we look at it at a large scale, every additional and complicated step sucks in more resources out of us as a society. It is no different than the government being inefficient. Hundreds of thousands of very bright people are dedicating their lives to financial instruments, getting paid billions. And beyond a certain level, all it brings is additional risk and artificial growth that will inevitably come down when the bust part of the cycle begins. There is a lot of research on this topic proving that too much finance is bad for the economy. It is hard to say where the entire problem originates from. American financial system has always been prone to taking bad risks. But I do think it goes beyond high risk, high reward logic. It's not just America wanting to take higher risks for higher rewards. I don't think American successes happen because of its fragile financial sector. I think American economy succeeds despite of it. I think a big portion of the problem is government policy. And I don't mean lack of regulation. American financial markets haven't been unregulated for a long time. The federal government today regulates the markets in a lot of ways. I argue that it's simply bad policy. All the way from disallowing federal branch banking in 1800s to systemically encouraging subprime mortgages in 2000s to even today lacking a central authority to regulate the banks. I think a lot of America's financial problems have been caused by bad policies, and I think this is because the American government has never cared about establishing a stable financial system. And it is very hard to make an anti-American case as a Canadian with all the economic problems going on here. American economy grew at an incredible rate in the last 10 years with manageable rates of inflation. It has been way too long since the financial crisis, and the world has forgotten. But I do believe when the next global financial crisis hits, the Canadian banking system will be vindicated, and the Wall Street will once again show its structural weakness.